everyone, John Chow here from johnchow.com, and welcome to another episode of Driving with John Chow. Right now I have the Tesla Autopilot engaged. Just had a lunch and I'm right now going back to pick up Sally from school. Yeah, I went for lunch at noon and it's now 2:30 and now I'm going to pick her up from school. Yeah, 2.5 hour lunch, typical .com lunch. Anyway, I want to teach you guys a couple of financial terms today, and they may be terms you may have heard of, may have not heard of, but anyway, it involves the credit card companies and credit card terms. You see, and this is from the view of the credit card company, not from the view of the people who have credit cards, but the credit card company. You see, the credit card company divides their customers into two groups. The first group is the group that charges up on a credit card, and then instead of paying the whole balance off, they pay either the minimum amount or they pay whatever they can, and they let the balance carry forward. And this is the group that the credit card company actually makes most of the money from, because they're incurring interest, and very, very high interest, I suspect. Anyway, the credit card company calls this group the revolvers. That's what they call it. They're called revolvers because they're revolving credit. They're basically the revolving door. Every month they don't pay the full balance off, and they pay minimum amount or they pay some down, and then they'll charge it back up again. They never bring the balance to zero, and as a result, this is the credit card company's bread and butter. They make most of the money, almost all the money, from this group called the revolvers. That's what they call. So if you don't pay off your credit card every single month, you owe a revolver. Now the second group is the group that pays off the whole balance every single month. Doesn't matter what it is. So if they charge their stuff, and then when the bill comes, they pay it all off. And the credit card company has a term for this group of people, as well. And this group is called the deadbeats. Yeah, I'm serious. They're called the deadbeats. Yeah. Now, when you hear the term deadbeat, it conjures up a negative term, because like deadbeat is usually associated with someone who doesn't pay. The deadbeat dad. That customer's a deadbeat. In other words, deadbeat means they don't pay. But in the case of the credit card company, a deadbeat means we don't make any money off of this guy. He's useless to us. He takes advantage of our system. He uses the card and he charges on it and incurs no interest because he pays it all off in time. And sometimes, worse, we're giving him a mileage card or a points card, so he's charging on it. He's getting free points. He's getting free rewards, and he's incurring no interest. So he's a deadbeat. That's a deadbeat. Now, normally, I would say this. No one wants to be known as a deadbeat. I mean, it's just a negative term being called a deadbeat. However, when it comes to credit cards and being a credit card customer and given a choice between being a revolver or a deadbeat, I think you should be a deadbeat. Yeah, there you go. Be a deadbeat if you have a credit card, and if you're a revolver, well, you don't be a revolver. Be a deadbeat. There you go. That's the only deadbeat you should be. Don't be any other deadbeat. Be a deadbeat to the credit card company. John Chow from johnchow.com. Thank you very much for watching. Give me a thumbs up if you're a deadbeat. I guess give me a thumbs down, you're a revolver. Actually, no, I'll give you a thumbs down, you're a revolver. All right, so be a deadbeat. All right. Like and share my video, subscribe to my channel, and I'll see you guys on the next episode.